What if I told you that the greatest financial collapse in American history didn't begin with panic? It didn't start with fear. It didn't even start with bad news. In fact, the final hours before the 1929 stock market crash looked shockingly normal, calm/optimistic, almost celebratory. But hidden beneath that calm was a quiet imbalance, a chain reaction already triggered, unstoppable, silently counting down like a financial time bomb. And here's the mystery. How did an economy that looked so unstoppable collapse overnight? And why do modern markets show the same warning signs today? Today, we're not just revisiting history, we're walking hour by hour through the final moment of America's greatest financial illusion, and how the world slid into the Great Depression without realizing it. Setting the stage, the illusion of prosperity. Montage: 1920s jazz, factories, skyscrapers rising, Model T cars on assembly lines. To understand the final hours before the crash, we need to understand the decade that created the disaster. The 1920s were explosive, a period known as the Roaring Twenties. America had just emerged victorious from World War I. Industries were booming, and the average citizen believed something new. That prosperity wasn't just possible, it was permanent. But here's the twist. The 1920s weren't truly prosperous. They were leveraged, borrowed, and inflated. President Calvin Coolidge, strong pro-business stance, hands-off government. Andrew Mellon, U.S. Treasury Secretary, champion of low taxes and minimal regulation. Federal Reserve, young, inexperienced, and inconsistent in its policies. Wall Street speculators, fueling a new culture of buying stocks on credit, called margin trading. This wasn't stable growth. This was acceleration without brakes. And Americans believed the lie. After all, the market kept rising. Every correction was followed by a bigger rally. Newspapers declared, "A new prosperity has begun." But behind the scenes, a quiet instability was forming, and it would come crashing down in a matter of hours. The build-up to a fragile system visual graph, rising steeply, showing stock market soaring through the mid-1920s. From 1924 to 1929, the stock market more than doubled. Not because companies doubled in value, but because people were borrowing money to buy shares, creating artificial demand. Here's the cause and effect chain. 1. Banks offered easy loans, gives people borrowed to buy stocks. 2. Demand for stocks shot up, gives prices climbed beyond real value. 3. Rising prices attracted more new investors, gives who borrowed even more money. 4. The market became a bubble supported by debt, not fundamentals. And no one believed it would end, or rather, no one wanted to believe it. By 1929, more than half of stock purchases were made on margin. Imagine buying a $100 share with just $10 of your own money, and borrowing the other $90. That's how fragile the system was. If prices fell even slightly, the entire structure would collapse. And then, in October 1929, the first cracks appeared. Rising tension. The days before the crash. Newspapers with headlines about volatility. Brokers whispering nervously. On October 23rd, the market suddenly dropped. A small drop. But big enough to trigger anxiety. Investors who had borrowed money faced margin calls. Their brokers demanded more cash to secure their loans. And now something new entered the story. Fear. But here's what makes the final hours before the crash so chilling. Most experts dismissed the fear as temporary. Newspapers reassured readers, bankers claimed everything was under control. And then came Thursday, October 24th, a day that would become known as Black Thursday. But the real shock, Black Thursday wasn't the crash, it was the warning shot. And the warning was ignored. The final hours before the crash, hour by hour. Breakdown clock ticking, black and white footage of Wall Street. Now we enter the final hours. The last stretch before the collapse. The point of no return. Hour 1. The early morning come October 28, 1929, 9 a.m. traders arrive to the floor. There's tension, yes, but nothing that screams disaster. In fact, many believe the previous declines were bargains. Key assumption: the market always bounces back. This assumption will destroy millions of portfolios in just hours. Hour 2. Opening bell shock. 9:30 a.m. The bell rings, and suddenly chaos. Sellers flood the market. Orders pour in faster than the ticker tape can record. Some companies drop 5% within minutes. Why? Because overnight, foreign investors began pulling money out of US markets. Confidence was evaporating globally, but still, no one fully understands what's coming. Hour 3. The spiral begins 10 a.m. Margin calls hit like artillery fire. Investors must pay more money or their stocks will be sold automatically, and most don't have the money. These forced sell-offs accelerate the drop. It's the financial equivalent of gasoline on a fire. Hour 4 silence from the Federal Reserve 11 a.m. Banks quietly call the Federal Reserve. They want intervention, support, a signal to calm the markets. The Fed hesitates. They don't want to encourage speculation. They don't want to appear to rescue reckless investors. That hesitation becomes one of the most expensive policy mistakes in US history. Because without support, the selling intensifies. Hour 5 panic takes over 12:30 p.m. The trading floor becomes a battlefield. Phones ring non-stop. Brokers scream. People push, run, sweat, curse. But here's the eerie part. Outside on the streets of New York, life continues normally. Most Americans have no idea the economy is imploding. Hour 6. The breaking point 1 p.m. More than 12 million shares have been traded. An all-time record. But the most dangerous moment is not the selling. It's the silence. Banks stop answering phones. Brokers stop giving updates. The tickers fall behind by more than 2 hours. Investors are flying blind. Some lose fortunes without even knowing it yet. Hour 7. The collapse. 2:30 p.m. The final wave hits. Blue-chip stocks, once considered untouchable, crashed 20% in minutes. General Electric, US Steel, American Telephone and Telegraph. Nothing is safe, soft, heavy. And in this moment, the American dream fractures. Hour 8 closing bell. Too late to save anything. 4 p.m. The bell rings. The worst trading day in US history is over. But the real disaster, it's only beginning. Tomorrow will be worse. And the next day, worse still. The beginning of the Great Depression. Empty factories, jobless crowds, soup kitchens with the market collapse. Margin debt detonated. Banks lost billions and began to fail. Businesses collapsed. Farmers went bankrupt. Unemployment soared. Statistics that shocked the world. The stock market fell 89% from its peak. Industrial production dropped 50%. Unemployment reached 25%. Over 9,000 banks failed. This wasn't just a crash, it was a societal breakdown. And it happened because the system was built on illusions, not fundamentals. Why the recovery efforts didn't work? The US government attempted multiple fixes, but each one failed. And here's why. 1. High interest rates. Fed mistake. The Fed raised rates in 1928 and 1929 to slow speculation, but they ended up choking the entire economy. 2. Tariffs. Smoot-Hawley Act, intended to protect American jobs, but instead triggered a global trade collapse. 3. Balanced budget approach. Government tried to limit spending during the crisis. The wrong move during deflation. The combined effect, the depression deepened, and millions suffered unnecessarily. Why this story still matters, narrator. But here's the part that hits uncomfortably close to home. When we look at modern markets, the patterns repeat, that matched 1929 almost exactly. 1. High levels of margin debt. Today investors borrow billions to trade, just like the 1920s. 2. Asset bubbles inflated by speculation. Tech stocks, crypto, real estate prices rising faster than fundamentals. 3. Overconfidence and belief in permanent prosperity. Many investors believe modern markets can't crash because of tech or central banks. 4. Uncertain Federal Reserve policies. Just like 1929, mixed signals cause instability. 5. Global interconnected markets. If one region collapses, the shockwaves spread instantly. The lessons of 1929 aren't warnings from the past, they're warnings for the future. So, what can we learn from the final hours before the 1929 crash? Takeaway 1. Markets don't crash suddenly. They crack quietly. First warnings appear long before disaster, but people ignore early signals. Takeaway 2. A debt-fueled prosperity is fragile when growth depends on borrowing. It can vanish overnight. Takeaway 3. Overconfidence is the most dangerous economic force. The belief that it can happen here has triggered every major collapse in history. Final warning to the audience today: the world is more leveraged, more interconnected, and more dependent on confidence than ever before. And just like 1929, crisis begins quietly. If you found this breakdown valuable and want more deep dive financial documentaries, hit like, subscribe, and turn on notifications. Your support helps us bring more educational content that reveals the hidden patterns shaping our world. Thanks for watching, and remember, history doesn't repeat, but it rhymes, and the next verse may already be beginning.